Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Let's get to Lorraine Tan. She is our guest. Lorraine is Director of Asia Equity Research at Morningstar. She joins us from the Lion City of Singapore. Lorraine, is the reaction that we're seeing across equity markets in the APAC solely due to this weak print on U.S. jobs and the worry that the Fed may be behind the curve?
Yes, certainly for the most part. I think that raises the risk that the economy is going to be slower than expected. The slowdown could be steeper, and that hurts earnings. We've got, obviously, in the Japan market, the situation with the yen rising and offsetting share market gains as well in U.S. dollar terms. So those are two distinct, I think, factors at the moment.
Lorraine, what about what we're also seeing in terms of this unwinding across assets? Traders a couple of weeks ago when we saw that short squeeze were also reconsidering their leverage bets. Is this what you're also seeing in terms of the pullout from stocks across the region?
Actually, we started seeing a little bit of a defensive switch starting in the second quarter. The sector that outperformed was utilities. I think there was some switching at that point into the yield plays, the expectation that that the Fed was going to cut anyway. So we did see technology as a whole sort of not really outperform, or was flat roughly in the second quarter, except maybe for a couple of key names like TSMC, MediaTek. Really, the AI plays are what was driving that higher. So I think if you're talking about some of the defensiveness, yes, I think people want to lock in their gains. I think this behavior will probably continue for a little while.
So if you expect the behavior to continue for a while longer, I wouldn't imagine that you employ a buy the dip strategy at this point, right? I mean, it was only a short while ago we had the Nikkei above 40,000. We're at around 33,000 at the moment.
Yeah, we've got to let things, I think the tendency is you want to have things settle down a bit, but we really don't know where it's going to bottom, let's say. That's difficult to tell. We'll be much more focused on where we see value. And obviously, we take these as opportunities to pick up names that we like when they come down. So yes, there were a lot of names that were, particularly in Japan, that were getting slightly expensive. There were laggards, obviously. I think there's still factory automation names in Japan that are good proxies to a China recovery without the geopolitical issues. So I think those are some names that we like. As they come down, I think the Japanese banks are something that we'd want to look at for the longer term, because with interest rates moving a little bit up in Japan, we think that the upside to ROE is still there for the banks in Japan.
Just picking up on your point on the banks, though, they were among the sectors that were the worst hit late last week. So it makes you wonder, even if their profitability might be boosted with these rate hikes, do those concerns broadly about the Japanese economy being able to withstand BOJ rate hikes kind of overshadow the outlook for them?
Well, we don't expect the BOJ to actually raise rates on a very aggressive level. We've maintained our view that it's going to be a very gradual upside. Firstly, most of the lending or borrowing in Japan, the mortgages are not fixed. So I think the BOJ is going to be wary of raising rates too much based on those situations, obviously looking at what's going on with inflation. So inflation pressure should ease, and even if they are maintained at sort of current levels, we don't expect the BOJ to really raise rates aggressively.
What other sectors do you like in Japan? The medium-sized companies, are they going to be the ones perhaps benefiting a bit more compared to the large caps?
We don't really differentiate between small and large. We look at where the value is. I think, obviously, we do like some of the names, as I mentioned, that could benefit as the Chinese economy starts to recover. I think that's going to be, that might come out, we're looking for example, China real estate prices to start to stabilize on a broader basis. early into 2025. So sometime over the next 9 months, we expect China consumption data to start to improve. So I think that has a lot to do with the confidence in China. And once that picks up, the proxies to that China recovery, some of the Japanese names there, like factory automation side, Fanuc, Yaskawa, who have been lagging, we expect those to do better. Obviously, from speaking on China itself, we still like the domestic consumption plays there.
And you've liked it for a while now, and this is all banking on the expectations that we'll see that recovery eventually, one that has been delayed a number of times. We're hearing over the weekend how China is rolling out an action plan to boost domestic consumption. Do you think that's going to move the needle a bit further?
I think anything that can help should hopefully help. But basically, we feel that employment will always lag, so that part of it could be a bit slow in terms of recovery. Where we do think that to be a faster tick up is in confidence. So we do need to see the real estate home prices start to stabilize there. So with the local governments absorbing some of the excess inventory, we actually expect that excess inventory levels to sort of start easing over the next 9 to 24 months.
We get the export data for China midweek. Are you expecting the number to come in a little on the stronger side for July? And if that's the case, will industrial production continue to be this bright spot for China?
It's kind of hard to say. I think a lot of the recent uptick probably has to do more with seasonal factors than a general trend. I think if you look at the risks that we're seeing with the U.S. data, we do expect U.S. economy to slow growth there, to slow below 2%. So we are anticipating pretty slow, much slower global growth over the next 12 months. So that's going to weigh on China data. So we may see seasonal bumps month to month, but we don't really expect a big change in the trend.
Lorraine, also want to get your thoughts on the tech sector. I mean, we're hearing how Berkshire Hathaway is almost halving its stake in Apple. How do you view it overall among these tech names that are already being hit by doubts about whether AI can deliver?
I think the market ran ahead of expectations, and therefore the valuations of some of the leading names in this space have really shot up, probably overshot fair valuations. So what we're seeing is that we're looking at these names come down to much better, more reasonable levels. If you look at the broad U.S. market, really the broad market didn't perform as well as the Magnificent Seven. But so those are the names, obviously, that will pull back. NVIDIA, even coming down to the level it is now, is still probably fairly valued in our books. So we still think they're before we buy some of these names, there's probably still a little bit room to the downside before we pick these names up.
Okay, you touched on this earlier, how when we saw that sell-off late last week in US, there were some sectors that were still pretty buoyant, utilities, real estate. What do you think the key drivers are going to be towards the end of the year?
I think with slowing growth and the fact that interest rates are coming down, I think investors have started to rotate into utilities, the more defensive names, the names with potential dividend growth. So those and attractive yields, obviously. So utilities actually has been outperforming this year. We think there's room still in some of the other names such as REITs. Yes, it's the commercial real estate market is difficult and challenging still, will likely be the case for the next few years. But we anticipate that most of the negatives are probably reflected in share prices. So we think there's room for some of the REITs to start moving up. And then obviously some of the traditional dividend plays, some of the aerospace defense names particularly defense names probably are also a little bit more stable.
Lorraine, thank you so much for making the time to chat with us. Lorraine Tan is Director of Asia Equity Research over at Morningstar, joining from Singapore on the Monday morning edition of Daybreak Asia. welcome our guest, Victoria Bills. She is the Chief Investment Strategist at Banrion Capital Management. And Victoria joins us from the windy city of Chicago. Nice of you to drop by. Thanks so much.
Always happy to blow on in from the windy city.
So let's start with the jobs data, because it looked like the market is convinced that we are now verging on a hard landing. Goldman Sachs raising the probability of a recession call here. Is it that dire in your view?
I think, as always, the market has a tendency to over-exaggerate some of these plays, or even some of these kind of downward metrics that they might see. Even if we consider 2018, 2019 pre-pandemic levels, we were seeing unemployment around a 3.9%. 4.3% is just around average, I would say, of what we've been seeing in a normalcy times. And even with the initial jobless claims that we've been seeing of about like 249K, a lot of those job losses have actually been coming from the technology sector, which many would argue has already been relatively bloated. And when it comes to kind of like a lot of things in the AI space or even AI plays, I would say that a lot of these tech companies are kind of peeling back or kind of pulling back some of their workforce in order to kind of be more leaner in their structure, rather than, again, some of the larger claims that this is examples of what might happen for a hard landing. And some of the other things that I've been seeing also that kind of, I would say, lend kind of a credence that this isn't necessarily a hard landing is that we've been seeing inflationary pressures coming down. We've been seeing GDP growth at like 1.5% for the US economy. Mm-hmm. So a relatively strong jobs market on top of GDP growth. Even with those jobs claims, I think it's kind of more of an overplay and or exaggeration that the market tends to do in these moments.
So a moment ago, I mentioned the selling that we had in the equity space on Friday, and I'm looking at the E-mini futures trading now for the American market with the S&P 500 off about 0.8%. NASDAQ 100 is down another 1.3%. Would you be looking for more weakness in the days ahead?
I would definitely be looking for more weakness. Again, if I were the Fed, if I were Chairman Powell, I would be looking for be looking for that CPE or even that PCE data to have a spike if I wanted to consider not even doing a rate cut. I would have considerations around GDP growth rather than looking at this one data point around unemployment rate or even like initial jobless claims, because again, it's more so indicative again of strong job growth in the industrials, healthcare, and even like retention around those sectors. And it's more of a kind of I would say a sell-off of technology stocks and technology-based companies.
Is it too late to participate in the bond market right now? Do you think the easy money has been made?
Not necessarily. I think there's always opportunity wherever you look in the market, whether we're looking at short-term play in terms of mortgage rates or anything like that. I think or even private credit. I think that there's still an argument to be made around private credit space, especially for small, mid-sized companies. A lot of VC-backed companies or early companies from 2020 going into 2022 are still kind of looking for those up rounds and kind of struggling to raise VC dollars. And so a lot of those companies have started to turn to the private credit space. And so we've been seeing a huge boom in opportunity in that area. And again, with rates kind of potentially coming down, there's still margins to be made, but it's definitely not going to be the top dollar that we were seeing for the past year and a half.
So you don't seem to be in the camp that the next move would be a 50 basis point rate cut in September. Am I right on that?
So not quite. So I do believe that there is potentiality for a rate cut. I think that, again, some of the metrics and everything that we've been seeing has come down enough to show that inflation, while still a problem or a potential tailwind in the market, is something that is not as much of a factor or a burden as it used to be earlier this year. So I do believe that there is a possibility for a rate cut to happen in September, but I do believe that we're still going to have to, again, as long as these numbers continue to stabilize and as long as we continue to see a stable growth in the U.S. economy, I think that will lead credence to a September rate cut right now. But again, my point is that the U.S. economy is going strong and is doing well. But again, we've just been seeing a slowdown from what we had been seeing in previous years, which is exactly what the Fed wants. I'm
curious as to whether or not you see politics, whether it's geopolitics or domestic politics, becoming a factor here in markets in the near term.
It definitely does. Depending on the candidate that wins the presidency come September this year, November, we can basically expect Trump is very pro crypto, very pro business and capitalism. And so we can see, or we can predict there's probably going to be a huge rush or surge that's going to happen in the stock market from that perspective. If we're going in the realm or in the bank of Kamala Harris, I think I'm not as well educated on her talking points, but I think one of the things that she's going to be very pro on is, again, creating better relations with China as well as in the United States, but also working to try and keep those job numbers very strong here in the U.S. economy. I would say that just given Trump's VP pick and everything that we've been seeing there, he's kind of taken on a very pro-corporate stance. And I think Kamala would probably do the same thing. And so the reaction to that would probably be very positively received from the markets from both sides.
Are you primarily focused on the U.S.? Are you seeing any opportunities offshore right now that we need to know about?
Our primary focus at this time is in the U.S., but in terms of offshore opportunities, if I'm looking at companies that are in if I'm looking at companies that are in the technology space or even banking, there's plenty of opportunity that's happening in India. If I'm looking at pharmaceuticals, Novartis is an amazing company that we are very supportive of. Overall, they've had just like a very good year in terms of market cap and has been able to have like a great compelling story around just earnings. But I would say that most of the companies that we focus on is domestic.
Victoria, we'll leave it there. Thank you so much for making time to chat with us. U.S. Sunday night in Chicago. She is Victoria Bills, Chief Investment Strategist at Banrion Capital. We welcome our guest, George Boubouras. He is Managing Director at K2. He joins us from Sydney. Always a pleasure, George. I think we have to begin with the employment data and this issue of a growth scare. Are you worried about maybe a hard landing happening in the U.S.?
Hello, thanks for having me on. Not scared at all. Not looking for a hard landing. It's just one data point. And yes, it is quite soft, the data. And even the government employment data was quite weak as well. And more people looking for work. But one data point in itself is not policy effective in that sort of scenario. But we're just looking at the soft landing scenario. The bond market's done an extraordinary rally months to date, or over the past 4 weeks, I should say. And that inversion is quite concerning. But we just say that everything's on the table. The language is quite consistent for a September rate cut. And that's 25 basis points by the Fed.
So with a pullback that we have been seeing in equity prices, not just in the U.S. on Friday, but I'm looking at futures trading in Chicago for the Japanese market, we could be down by more than 1,100 points. Would you be looking at these moments of selling as opportunities to add to your position if you're long stocks right now?
Active fund managers like ourselves globally have been part of that rotation that's been on again, off again for 2 years now. But that rotation out of S&P 500 and trying to take those gains, but remaining within the equity asset class. And so we're still looking at that. And what we would say is there's opportunities for S&P 500 at the end of this reporting period to have a look through on if it's overdone on the weakness. And also, having said that, we'll be looking at Nikkei as well in this retracement because of the BOJ movement last week. And that obviously was stretched on valuations like the S&P 500. That'll be two markets we'll be looking for. And if we don't believe it will be an aggressive rate cut cycle once it begins, it will be very shallow. So that is supportive for mid-cap US, but not as supportive as some people are pricing in. So there's a number of different moving parts. Remain in that equity asset class because it's not a hard landing. A non-recession scenario has been engineered, we believe, to come through, and that's still positive for aggregate earnings with a lot of unevenness across the sectors, of course.
So, but by sectors, those being most sensitive to swings in the economy, materials, industrials, even the financials, am I right?
Yeah, exactly. So the materials, let's start with there. They've obviously, they've really come off a lot and been quite weak, but taking a step back, and commodities have been weaker over the past 3 months, just as the economic data, the economic pulse in the developed world has been weak in the past 3 months. But even agricultural commodities and bulks and metals and even energy. But let's just take a step back. Even despite the weakness in bulk in resource sectors in general, you're still looking at US 100 a tonne, 103 for iron ore. That is quite a reasonable price point at this stage of the cycle. It's just that the corrections happened on the back of that softer economic pulse, the second order condition. The thing to reinforce is 3 months of softer data is coming through, but it's not going to be a continuation of it. Rate cuts begin. They're going to be shallow rate cuts. Don't expect anything aggressive or 100 basis points of rate cuts between now and year end is how we'll be looking at it.
You know, the time is kind of interesting because if this is a mild growth scare that's happening in the U.S., it comes at a time when there is a great deal of concern about the strength of the Chinese economy. We'll get the trade data on Wednesday. Export figures may show a little bit of strength, but I think that exports really for China have been a bright spot and one of the things that has kept industrial production growing. If we have continued lackluster growth in the Chinese economy, is that going to be a big factor in holding back the growth rate of the global economy going forward, let's say in the next 12 months?
It does, but it's all about timing. So quite clearly, while there's some good points of the Chinese economy, they're in the world of pain on the construction cycle with property. That's the biggest correction underway the world's ever seen. Let's just say 5 to 10 years to get out of that. But they've been concentrating all of their factors of production in fixed cost investments into the export sector. It's not about domestic demand. We all know that narrative, and it's pretty clear. So the way to look at it is the more the Biden administration takes on the tariff head on, which is legitimate given what's been going on in recent years, then that is going to be softer for the industrial production cycle and therefore for commodities, all things being equal. But it's a catch-22. It's that there is that softness to the Chinese economy, but then there's a reacceleration in certain parts of it. But it's not domestic demand driven, it's export led. But we'll be looking at it from softer economic data to the global GDP numbers from China going forward, not growing contribution from China. So they're in a unique situation there, but the export sector is going to continue to find other markets outside of the USA, Canada, and obviously Mexico with that old region in export.
So you're in Sydney. We have a rate decision later in the week from the Reserve Bank of Australia. The expectation right now is that the RBA will hold the target rate at around 4.35%. I'm imagining that's where you see things right now, especially after core inflation cooled in the second quarter. Walk about economics now. How are things in Australia?
Yeah, the very quick narrative for Australia is that the Reserve Bank of Australia, overgeneralisation, we are behind the curve. Too late to start the rate hike cycle and not enough. And it's led to very stubborn core inflation relative to other developed economies because of the very strong fiscal stimulus from the federal government and the state government level. Now, I've said just a lot in there, but the point to reinforce is it's very difficult to reconcile the logic of making the case of rate cuts in Australia, all things being equal, given the stubbornness of the second order condition and that services inflation, and given the strong fiscal stimulus at the federal and state level. Now, that's at odds with Canada, USA, New Zealand to some effect, ECB and the UK. But that's how you should look at the Australian economy. In aggregate, it's holding up because of the export sector. There is a lot of pain and unevenness across the domestic demand side of things. But that sticky inflation in the core, that's the thing to take out of Australia if you're looking at it from offshore.
So growth, I believe, in the first quarter was very weak. Is that something that's going to be kind of stagnant very quickly for the foreseeable future?
Yeah, very stagnant for the foreseeable future for growth in Australia. It's going to be export-orientated led, and domestic demand is really that soft part of the Australian economy.
George, it's always a pleasure. Thanks for making time to chat with us. George Boubouras there. He is Managing Director at K2 in Sydney. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.